Picture yourself at a dinner party in 1998. Someone mentions a new internet company. Nobody asks whether it makes money. The question is whether you can still get shares before it doubles. This was the emotional weather before the dot-com bubble burst. Excitement, confusion, envy, and the strange sense that the old rules of investing were becoming obsolete. Today, it is easy to look back at the late 1990s and see a warning label. We know what came next. The Nasdaq peaked in March 2000, then fell hard. Companies with flimsy business models disappeared. Fortunes made on paper vanished. But before the crash, the story felt completely different from inside the moment. The internet was not a gimmick. It was visibly changing everyday life. People were buying their first home computers, hearing the whine of dial-up modems, sending email instead of faxes, and discovering that a website could reach customers around the world. That part was real. The web really was going to transform commerce, media, communication, and work. And when a genuine technological revolution arrives, investors face a difficult problem. They can be right about the future and still be wildly wrong about the price they pay for it. In the late 90s, the market began rewarding any company that seemed connected to the internet. Adding .com to a name could send a stock soaring. A company could have a clever pitch, a new website, and a plan to grow later. Profit was often treated as an old economy concern. The new vocabulary was users, clicks, page views, eyeballs, first-mover advantage, and total addressable market. For an investor watching from the sidelines, this was intoxicating. Every day seemed to produce a new initial public offering. A stock could open in the morning and finish the day far above its offering price. Financial television turned market moves into a live sporting event. Co-workers compared trades at lunch. Taxi drivers, students, and grandparents all had a tip. The feeling was not simply greed, it was fear of being left behind. Imagine owning a careful portfolio of profitable industrial companies, banks, or consumer brands, while an internet stock you dismissed rises 50% in a week. Your sensible approach starts to feel embarrassing. The neighbor who bought a company because he liked its logo suddenly looks like a genius. Meanwhile, the cautious investor feels as if they are missing the greatest opportunity of a lifetime. That social pressure matters. Markets are never just spreadsheets. They are stories people tell one another. And the story of the dot-com era was that the internet had made traditional valuation obsolete. There was a kernel of truth inside that claim. Young technology companies often do need years of investment before they become profitable. A business that spends aggressively to gain customers can be rational. The problem comes when every business is treated as if it will eventually become the winner. During the boom, many investors stopped asking the uncomfortable questions. How much does it cost to acquire a customer? Will that customer stay? Can the company charge enough to cover its expenses? Does it have a durable advantage or just an interesting domain name? What happens when competitors copy the idea? Those questions did not disappear. They were simply drowned out by rising prices. The market also created a feedback loop. Rising stock prices made companies look successful. That success attracted more media attention, more analysts, more retail investors, and more capital. More capital funded more advertising, more expansion, and more dramatic growth stories. The higher the market went, the easier it became to believe that the market was proving the story true. In a hot market, going public can feel like a graduation ceremony for a startup. In the dot-com era, it often became a spectacle. Investors knew that shares could jump on the first day, so demand built before the businesses themselves had been tested. Some people bought not because they understood the company, but because they believed someone else would pay more tomorrow. That is the key emotional shift in a bubble. You stop investing in the cash a business might earn over time. You start investing in the behavior of the next buyer. Of course, not everyone was swept away. Some investors warned that prices had become detached for reality. Some fund managers held back. But being early and being wrong can look exactly the same for a long time. A person who questioned the bubble in 1998 had to watch it grow through 1999. That is not just intellectually difficult, it is emotionally painful. And the most persuasive evidence for a bubble is often the money other people appear to be making. By early 2000, the mood was still exuberant, but cracks were showing. Interest rates had risen. A few highly valued companies disappointed investors. The belief that every internet business deserved unlimited patience began to weaken. Once prices started to fall, the same feedback loop ran in reverse. Investors who had felt brilliant a few months earlier became desperate to protect gains. Companies that needed fresh cash found it harder to raise. Analysts and journalists started asking the questions that should have been asked all along. Some businesses survived and eventually became giants. Many did not. The crash was brutal, but it did not prove that the internet was a fad. Quite the opposite. The internet kept reshaping the world. What changed was the market's willingness to pay any price for that future. That is why the dot-com bubble still matters. It is not a story about foolish people falling for a silly invention. It is a story about a real breakthrough meeting human psychology. Hope became certainty. A good narrative became an unquestionable one, and rising prices became evidence that prices should rise even more. So what did it feel like to invest before the bubble burst? It felt like standing in front of a door that everyone else was rushing through. Behind it was a future that genuinely seemed enormous. The hard part was knowing that a huge future does not guarantee a good investment today. That lesson is uncomfortable because it never gets old. New technologies will keep arriving, new stories will capture the market, and every generation of investors will have to separate the truth of an idea from the price of a stock.